It's a shocking call. I am waiting for Savita Subramanian's entry point to buy the first share.
3,800 is the price target on the S&P 500 over at Bank of America. Savita, to give you some credit, 6 months ago, this was a very, very bullish call. We have moved really, really quickly in this equity market since early November. I imagine you've had some pushback recently. Can you just shine a light on the conversations you have with clients at the moment? What do they sound like?
Oh, just emphatically bullish. I think that equity sentiment is increasingly euphoric. Conversations we have with investors of all types, so hedge funds, long-onlys, and individuals, the net message is you want to buy this market. This is what we're hearing from all types of clients. And this is how bull markets typically end. I mean, I don't know if we see a full-fledged bear market, but I think we are really well set up for, a 5 to 10% pullback, which happens super frequently. So 5% pullbacks happen, 3 times a year on average historically. 10% pullbacks happen once a year. We haven't had one since last Q2. So I just think this is a market that you don't necessarily want to enter here. I mean, look, at valuations are super stretched. We're at points in every valuation we look at, except for price to free cash flow, the market looks incredibly expensive. The sentiment is super bullish. I mean, this is a situation where all of our models are giving a net bearish message, whereas 10 years ago, all of our models were giving us a net bullish message.
Savita, you're the queen of the Excel spreadsheets. I want to go to the denominator of a lot of these different ratios right now. The bull case is earnings will deliver, that we'll see some form of high single-digit, double-digit growth, and that'll drive through to free cash flow. You know the drill. You say, maybe not. Is it a question of earnings, lack of confidence?
Well, it's not. I think earnings are going to be strong, but I think that you're going to start to see, we're looking for, 30% earnings growth this year. But if you look at multiple expansion last year, it was essentially, kind of anticipating that. So I think that the market gains are likely more in on earnings, and, the market anticipates. But I think the other thing to watch is free cash flow, right? The S&P looks cheap on free cash flow right now. The reason is companies have been underinvesting, underspending. Now, all of a sudden, you've got CapEx guidance through the roof. Everyone's saying they're going to spend on CapEx, be it, onshoring or just, refurbishing plant. We've got this infrastructure bill, which is encouraging CapEx in certain pockets. So I think that free cash flow generation is also compromised by the idea that companies are going to be spending more money. So I think that's another thing to watch. And then, of course, inflation. I think that's what we're really keeping an eye on, because if you look at the key theme this earnings season, inflation mentions increased by 800% year over year in terms of companies talking about margin risk, kind of higher costs from either labor or raw materials. Yeah. So I think that's the other risk that we haven't necessarily seen play through to margins and earnings. So, I think earnings are going to be fine this year. I think the market's anticipated a lot of that recovery. But I do think that inflation risk is what we want to watch here. I don't know if it's going to be as transitory.
Savita, can markets have a correction if the Fed keeps its policy where it is for the foreseeable future?
Sure. I think there are a lot of things that can cause a market correction. Look at some of the events we've had just over the last few months. We've had, de-risking, forced selling of institutional investors that have caused little air pockets in the market, or, forced selling across other parts of the market. So I think, liquidity risks to the S&P are actually higher than average. The other thing I worry about is that if you look at where pension funds and big money have moved, they've actually moved into a lot of illiquid parts of the market, like private equity, SPACs, like this sort of low interest rate beneficiaries. And if anything happens to rattle some of those parts of the market, I think that what big investors are going to be forced to sell is the S&P 500, the most liquid asset class. And that could put undue pressure on equities for totally non-fundamental reasons, for technical reasons. So, just the crowding of the S&P 500, the bullish sentiment, the fact that everyone's betting on low rates and high earnings, I think all of that just spells, very an environment that's very conducive for a pullback.